Investing versus trading. When you think of investing, you should probably think in terms of decades. Theoretically, an investor should not stress about the regular fluctuations in the market because they're in it for the long term. They ride out the downtrends because cryptocurrencies will eventually recover and make new highs. Investors allocate capital after looking at fundamentals such as effective management, competitive edge, and an underlying technology disruption potential. A trader, however, seeks to buy and sell cryptocurrencies to beat the investor, who is only buying and holding. An investor might be happy with some small returns on his investment, but that could only be the monthly return for a trader. As a trader, you buy an asset at a lower price and sell at a higher price in a possibly shorter time period. Trading is more aggressive than investing. Tools such as technical analysis indicators are used more often with traders than investors. When you think traditionally, investing and trading are two different methods of attempting to profit in the markets. The goal of investing is to slowly build wealth over time. Trading, on the other hand, involves more frequent buying and selling. We actually recommend trading around a core position. It's a blend of trading and investing. If you truly believe cryptocurrencies are a strong investment for the future, why would you sell completely out of them on a trade? There are many in the industry who have taught traders a far too simplistic approach to entering and exiting positions. I'm not sure how exactly or why this style of market play has become so persuasive, but it has. When I'm asked about a particular trade or maybe about the direction of the market, it's usually followed up by the need for a specific price target or price targets. The problem with most traders' and investors' mentality and their approach to markets is that the fact that they rely on just one entry and maybe 2 or 3 exit points or price targets. This is really restrictive and binds the optionality, limiting their successes pretty much outright. A new trader or an investor tends to plunge all of his or her capital allocated for a particular trade into the market all at once, at one particular price, at one specific moment in time. If you really think about the concept, it's kind of naive. Trading's really hard enough as it is to try to get both direction and time right. Why is it that some traders think they can pinpoint the exact moment in time and the exact price point to commit all of their hard-earned capital? I mean, this limits your odds of success right from the beginning. It's not just the one entry method that restricts your probability of success. It's the concept of 2 or 3 price targets. We trade based on an overbought and oversold method, using the cycle to our advantage. Employing a strategy where we don't buy in one lump sum at one price, but scale in over several entries while adding and reducing the position sizes further compounds the potential results. You pick a cryptocurrency that you think should have upside potential over the long term. Usually that's a project with good fundamentals, qualified management, disruptive technology, and bullish price action. Then take that cryptocurrency and start scaling into a core position. As an example, pick out a coin you want to eventually buy. Say that number is about 300 Ethereum you want to own. You buy about 50 to 100 Ethereum to start over the next week or so, watching the chart and slowly building into what is now your core position in Ethereum. Think of this core number as being the beginning to your investment. Once you become a little more comfortable trading, you could sell off a small amount every time the price hits a new high, or a slight pump in price above your initial entry. You slowly take bits of profit when price becomes high and possibly overbought. If the price of, in this case, Ethereum goes down, you buy. Once the price of Ethereum trades below your original buy-in average level, you should be attempting to get 100% into your position you decided from at the start. So if it goes below where you initially wanted to, you should be pretty much 100% at that point. In the same way as selling off a new highs, you should be buying each time it dips. Each time it dips lower until you have your 300 Ethereum you initially wanted. At this point, a core position is established, and then you simply just add and reduce based on the cycles.